Welcome to episode 2 of Reeling in Success, brought to you by Coastal Bay Wealth Management. I'm Nick Manns, your host and financial advisor. Today, we're diving into the concept of asset allocation. Just like choosing the right bait can make or break your fishing trip, diversifying your investments across different asset classes is key to a successful financial plan. Let's dive in. First off, let's talk about what asset allocation actually means. In the world of financial planning, asset allocation is about spreading your investments across various asset classes like stocks, bonds, real estate, and cash. The idea here is to balance risk and reward by diversifying your portfolio so you're not putting all your eggs in one basket. Think about it like this. When you're heading out for a day of fishing, you wouldn't use the same bait for every type of fish, right? Some fish go for worms. Others might prefer minnows or artificial lures. Different asset classes perform differently under various market conditions. And by diversifying your investments, you're setting yourself up for a more stable and successful return over time. Now, let's compare selecting the right bait for fishing scenarios to diversifying your investments. When you're fishing, you've got to consider factors like the type of fish you're after, the weather, and the time of day. In financial planning, you've got to think about your financial goals, your time horizon, and your risk tolerance. For example, if you're targeting bass in a freshwater lake, you might use a spinnerbait. But if you're after redfish in a coastal marsh, you might opt for live shrimp. Similarly, if you're young and saving for retirement, you might allocate more of your portfolio to stocks, which have a higher growth potential, but also come with more risk. On the other hand, if you're nearing retirement, you might lean towards bonds or other fixed income investments that offer more stability. When you're fishing in different environments, whether it's a mountain stream, a large lake, or an open ocean, each one requires a different approach. Just like your investment strategy should vary based on your individual circumstances and goals. Assessing your risk tolerance is crucial to aligning your investments with your financial goals. Here's how you can get started. First, know your goals. What are you investing for? Retirement? Buying a house? Saving for your kids' education? Your goals will shape your asset allocation strategy. Think of it like planning a fishing trip. Are you aiming to catch a trophy fish or just for a relaxing day on the water? Your approach will differ based on your goal. For example, if your goal is long-term growth for retirement, you might lean more towards stocks and real estate. For a short-term goal like buying a car, you will choose more liquid and less volatile investments like bonds or a high-yield savings account. Next, understand your time horizon. The amount of time you have to invest before you need the money will affect how much risk you can take. Longer time horizons allow for more aggressive investments. If you have all day to fish, you can try out different baits and spots, but if you only have a couple of hours, you'll want to go with what you know works best. Similarly, if you're 30 and saving for retirement at 65, you can afford to take more risks with higher growth potential investments. If you're 55 and planning to retire in 10 years, you'll want to protect your assets more and might lean more towards bonds with other low-risk investments. Evaluating your risk tolerance is also key. Are you comfortable with the ups and downs of the stock market, or do you prefer more stable, predictable returns? This will guide your investment choices. Some anglers love the thrill of chasing big game fish, while others prefer the steady catch of smaller, more abundant species. In financial terms, if you can handle the volatility of the stock market, you might invest heavily in stocks for their growth potential. If you prefer stability, you might allocate more towards bonds and dividend-paying stocks. Diversifying your portfolio is like carrying different baits for different fish. Spread your investments across various asset classes to manage risk and increase your potential for returns. Whether you're fishing a quiet lake or a bustling saltwater flat, having a variety of bait ensures you're ready for whatever comes your way. Similarly, a well-diversified portfolio helps you weather different market conditions. This could mean a mix of domestic and international stocks, government and corporate bonds, real estate, and cash. If one asset class underperforms, others may perform well and balance out your overall returns. Lastly, regularly review and adjust your portfolio. Life changes and market conditions can impact your strategy. Just like the seasons and tide change in fishing conditions, your financial situation and the market environment can change too. Adapt your bait and techniques to match. You might start with a more aggressive allocation when you're younger, then gradually shift to a more conservative allocation as you approach retirement. If your financial goals or circumstances change, like receiving an inheritance or facing an unexpected expense, you'll need to reassess and adjust your investment strategy accordingly. In summary, asset allocation is like selecting the right bait for a successful fishing trip. By diversifying your investments across various asset classes, you can manage risk and work towards your financial goals. Remember to assess your risk tolerance, understand your time horizon, and regularly review your portfolio. Fishing in different waters offers a rich variety of experiences, from chasing the elusive catch to enjoying a day of steady action. Similarly, a well-planned investment strategy offers potential for both excitement and stability, helping you achieve your financial dreams. Thanks for tuning in to Reeling in Success. I hope today's episode helped you feel more confident in your approach to asset allocation. Be sure to subscribe for more tips and insights on financial planning. Until next time, tight lines and sound investments.